1 week ago, this portfolio closed at $113,167. Today, it's worth $118,131. That's a gain of $4,963, or 4.39% in just 1 week. It's a great start, but one good week doesn't prove anything. The real challenge isn't making money for 1 week. It's making disciplined decisions, week after week, year after year. Hi everyone, welcome back to our channel. If you're new here, welcome to Precision Capital. This channel is a real-time documentary of my journey to turn $100,000 into $1 million. No paper trading, no hindsight, no deleting the losing trades. Every investment, every trade, every mistake, documented in public. One thing has changed since the last episode. In episode 1, I said the portfolio would start with roughly 80% invested and 20% allocated to trading. But that was never meant to be a fixed rule. Think of the trading side as the engine. Its job is to generate extra cash through short-term opportunities. As those trades make money, that cash gets moved into long-term investments to keep building the portfolio. In the last few weeks, the market gave me several opportunities to buy companies I already wanted to own. So instead of keeping cash on the sidelines, I put it to work. Let's take a look at what percentage of our portfolio is currently invested. As you can see, the portfolio is now about 95% invested. To me, that's not breaking the plan. It's the plan working exactly as intended. Now, let's take a look at what happened this week. Overall, this was a strong week for the portfolio. On the investment side, software continued showing impressive strength. Let's see. Palo Alto Networks gained more than 13% this week. ServiceNow was up around 7%. And SPGI also added roughly 6%. Especially Celsius. As you can see, CELH was up almost 20% this week. That's an impressive performance. Together, those positions were the biggest contributors to this week's performance. On the other hand, Constellation Energy was my weakest performer, down about 9%. Fortunately, it's one of my smaller positions. As you can see, it's only about 2% of my portfolio. If the stock continues pulling back, while my long-term thesis remains intact, I'll likely add more shares instead of selling. This week, I also received shares of Mobility Global, ticket symbol MBGL, through the spinoff from S&P Global. Since I own 20 shares of SPGI, I received 20 shares of MBGL in a 1-for-1 distribution. I think MBGL is a decent business, but I don't view it as a high-conviction investment like some of my other holdings. To me, these shares feel like a bonus, a gift that came from owning SPGI. So for now, I'm happy to hold them for the long term. But if I ever need to raise cash for a better opportunity, MBGL will probably be one of the first positions I consider selling. On the trading side, the story became much more interesting. Last week, my Palantir position was showing an unrealized loss of nearly $700. This week, it's completely reversed. The position is now up about $280. A gain of roughly 73%. That's a great reminder of why I don't make emotional decisions based on a few days of price movement. My SoFi position is currently up around $68, or 38%. Celsius is performing even better, up approximately $124, or 88%. None of these trades are finished yet. But so far, the strategy is working exactly as planned. Before we continue, I'd like to make one thing clear. Everything you see on this channel is for educational and entertainment purposes only. I'm not a financial advisor. Nothing in these videos should be considered financial advice. Always do your own research and make your own investment decisions. This week, I made 2 new decisions. One investment and one options trade. Let's start with the investment. I added Mastercard to the portfolio. I purchased the shares on July 1st at $525, investing approximately $4,200. Before buying any long-term investment, I always follow the same 3 rules that I introduced in episode 1. If you haven't seen that episode yet, I'll leave it linked in the top left corner. Those 3 rules determine whether a company deserves a place in this portfolio. Rather than making this episode even longer, I'm going to dedicate a separate video to breaking down this investment step by step. I'll show you exactly how I analyzed Mastercard, why I bought it at this price, what risks I considered, and what would cause me to change my mind in that video. Okay, now let's talk about the second decision. The second trade was on IGV, the software ETF. I opened a put credit spread on July 1st with an expiration date of August 21st. I sold the $90 put and bought the $85 put for protection. I opened 2 contracts and collected $290 in premium. If you're not familiar with a put credit spread, I won't go into all the details in this video. In short, it's a bullish option strategy, meaning I'm expecting IGV to stay above my short strike through expiration. Now, let's switch over to ThinkorSwim, and I'll walk you through exactly why I decided to take this trade. First, I always follow my trading rules, and the first rule is to analyze the overall market. This is the S&P 500 index. As you can see, the market has been trading sideways within this range. However, this week, I noticed a clear rotation. Money started moving out of some AI stocks and into sectors that had been beaten down, especially software. So taking a bullish position on the software ETF meant I was trading with the current market rotation, not against it. So rule number 1 is checked. Now let's move on to rule number 2, finding the best entry. This is the weekly chart of IGV. Like I mentioned in last week's episode, IGV formed a bullish reversal candle here. At that time, I said I wanted to wait for confirmation before entering the trade. That confirmation came on July 1st, which is when I opened the position. Now let's zoom in to the daily chart. On the daily time frame, you can see that even though the weekly chart had already formed a reversal pattern, the price was still trading below the 50-day moving average, which was acting as resistance. For me, I wanted to see a daily candle close above that moving average before entering. That happened on July 1st, giving me the confirmation I was waiting for. Now we need to answer a question. If this trade goes against me, where will I exit? As you can see here, this area marks the gap from the previous uptrend. If IGV breaks below this support level, around $88, I'll close the trade and accept the loss. Now, let's look at the final step, the risk versus reward. This is the risk profile for the trade. Let's focus on the green line and the box on the left. This shows exactly how much I can make or lose at expiration. If IGV stays above $90 through August 21st, I'll collect the full premium of $290. Can you see it here? If I held the trade all the way to expiration and IGV dropped below my spread, the maximum loss would be $710. That sounds like a poor risk-to-reward ratio. But remember, I already have an exit plan. I'm not planning to hold the trade all the way to the maximum loss. Like I mentioned earlier, I'll close the position if IGV breaks below $88. As you can see in the risk profile, closing the trade around that level would limit my loss to roughly $100 to $190, depending on when will I close the trade. That gives me a practical risk-to-reward ratio of around 1 to 1.5, or even 1 to 2, which I believe is a solid setup, considering the trade has about a 67% probability of success. After going through all 3 trading rules, I believed this was a high-quality setup, so I entered the trade on July 1st. Now, it's up to the market. So what is the lesson of the week? The biggest lesson I learned this week is that conviction only matters if you trust your process. Last week, my Palantir trade was down nearly $700. If I had reacted emotionally, I might have closed the position at the worst possible time. Instead, I stuck to my original plan because nothing about my investment thesis had changed. A week later, the same position is now profitable. That's an important reminder for me. Short-term price movements create noise. Good decisions are measured over time, not over a few trading sessions. That doesn't mean every trade will recover. Some won't. But I want every decision in this portfolio to be based on logic, not emotion. So, what am I watching next week? Right now, the S&P 500 is still trading sideways. That tells me money isn't leaving the market. It's simply rotating between sectors. Last week, software showed impressive strength. Now I'm watching to see if semiconductors are ready to bounce. Take a look at the Philadelphia Semiconductor Index, ticker symbol SOX. It's approaching the 38.2% Fibonacci retracement, which is the first support level. At the same time, let's switch over to the daily chart. On daily time frame, you can see that SOX is also sitting right on top its 50-day moving average. If buyers step in here, we could see the semiconductor sector regain momentum. But if these support levels fail, money may continue rotating into other sectors. One sector I'm watching closely is consumer discretionary, ticker symbol XLY. It's forming what looks like a bullish flag. So if it breaks out of the upper bound of the flag, it could become my next trade. As for my portfolio, I'm already about 95% invested and currently have 4 open option trades. So unless the market gives me an exceptional opportunity, I'll stay patient. We'll find out next week. If you enjoy this documentary series and want to follow the journey from $100,000 to $1 million, consider subscribing and join me on the journey. The market decides the outcome. My job is to make the right decision. I'll see you after the market closes next week.